Hello, my dear students. In the previous class, we were discussing about the accounting concepts. In that, we have already covered few concepts. So the remaining concepts will be covered in this class. So the first one is cost concept. The cost concept means that an asset acquired by a concern is recorded in the books of account at cost. The market price of the asset is ignored, and it is its cost price that forms the basis for all subsequent accounting for that asset. Cost includes the cost of acquisition, transportation cost, cost of installation, and cost of making that asset ready for use. So what do you mean by the cost concept? Here, whenever we are purchasing an asset, particularly fixed asset, say for example we are purchasing the machinery. So right now we are running our business in Vijaypur. So we are taking the machinery from Bangalore. So the cost of that machinery, the purchase price of that machinery is rupees 1 lakh, and we need to pay 10,000 transportation cost from bringing it to Vijaypur from Bangalore. So 1 lakh is the purchase price, 10,000 is the transportation cost, and in order to install that machinery and ready to make it for use or producing the goods, we are incurring another 5,000 installation charges or service charges of that particular machinery. So 1 lakh is the purchase price, 10,000 is the transportation cost, 5,000 is the installation charges. So 1 lakh plus 10,000 plus 5,000, we are going to consider it as 1 lakh 15,000. So the cost of that machinery will be 1 lakh 15,000. We should not consider only the purchase price. We should consider purchase price as well as transportation cost and cost of installation. This is the first point. And based on that cost concept, whatever the cost we have arrived, on that cost only we need to calculate the depreciation. We should ignore the market value of that machinery. We should focus only on the cost price of that machinery. And the cost concept is of relevance only for fixed assets and not for the current assets, in the sense that only the fixed assets are shown in the balance sheet at cost, and the current assets are generally shown in the balance sheet not at their cost price but at cost price or market price, whichever is lower. So the cost concept is applicable only for the fixed assets and not for the current assets. So what will happen if we are not following the cost concept? If the cost concept was not there, then the fixed assets have to be valued at the market price, and it will be difficult task. Every year the market value of the asset will change, and on that one we need to calculate the depreciation. So both the things will be difficult if cost concept was not there. So we are having cost concept here. So the valuation of fixed assets will be very easy, and the calculation of depreciation is also very easy. The next concept, dual aspect concept. So as we are knowing that each and every transaction is having twofold aspects. One is receiving of benefit, another one is giving of a benefit. The account which receives the benefit should be debited, and the account which gives the benefit should be credited. So for example, if you consider purchased goods for cash rupees 10,000, we have, there is a transaction, purchased goods for rupees 10,000. We have purchased the goods worth rupees 10,000 by paying 10,000 rupees cash. This one is the transaction. So what will be the effect here? So what will be the entry here? Here we are receiving the goods, so purchase account will be debited, and we are going to credit the cash account. The journal entry will be purchase account debit to cash account. Here the purchase account or goods account is getting the benefit, so this account will be debited, and cash account is giving the benefit, so it should be credited. So this is based on the dual aspect concept. So accounting equation concept, this is also called as accounting equation concept. Accounting equation will be assets equal to liabilities plus capital. At any point of time in the business, this equation holds good. Assets equal to liabilities plus capital, that nothing but the balance sheet will be always tallied here. So it is the very basis of the recording, because all the transactions are based on this concept. So this principle has has given the concept of double entry system. every debit has a corresponding credit and vice versa is based on this concept only. So based on this concept we are going to prepare the trial balance. Trial balance is nothing but the statement which contains the all debit and all credit balance of the various ledger accounts. The next concept is objective evidence concept. The accounting period concept is responsible for the preparation of the financial statements of a business enterprise annually. This concept means that all accounting entries should be evidenced and supported by source documents or business documents such as invoices, vouchers, etc. So this concept is very simple. Whatever the transactions we are recording, we need to keep the records of that transaction. It may be invoice, it may be vouchers, it may be bills, whatever it may be, we need to keep the evidence of each and every transaction. If we keep the records of every transaction, that will reduce the scope of manipulation. There will be no manipulation in the books of accounts if we keep proper records of that transactions. So it also reduces the personal judgment of the accountant. Next one, revenue recognition concept. Revenue recognition concept, it has two parts. One is revenue and another one is recognition. Revenue means simply income for the business. What will be the income here? The major income will be sale of goods, or it may be sale of services. That will be major income, that is treated as revenue. And there may be some other incomes like interest, royalties, dividends, rents, like that we have other incomes also. So all these will be treated as revenue for the business. Then revenue recognition, when we need to consider it as a revenue for our business. If we take the example, suppose we have taken a we are running a furniture business. We have taken a order of 10 furnitures for rupees 10,000 and we have received advance of 1,000 rupees. In January we have got order of 10 furniture and we received advance of 1,000 rupees. In the month of February we have delivered the goods, and in the month of March we will receive the payment. In January we have taken order, in February we have transferred goods to the client, and in the March we have received the payment of those furnitures. So this is a transaction. In which month we need to consider it as sales, whether in the month of January or whether in the month of February or in the month of March. As per this concept, revenue should be recognized in the month of February, when we actually transfer the goods to the other parties, and other party is legally liable to pay that amount at that moment. On that date it will be treated as revenue for the business. This is revenue recognition concept. Suppose as for the revenue such as rent, commission, interest, etc., they are recognized on a time basis. For example, we have a building, in that building we have let out some portion to other person. So in the month of March, for every month he need to pay rent to us. So in the month of March he is unable to pay that amount. He say I will pay the amount in the April, but we need to consider income in the month of March itself. Whether he is paid that amount or not, we need to consider it as in March we have rent income of so and so. But there are some cases when we are going to consider the proportionate of revenue. For example, if you undertake the contract work, construction work, suppose we are running a building construction work, so it will take 2-3 years time. So as per the revenue recognition concept, what will happen when we actually make the product ready, and when we transfer that product to other person, at that moment we are going to consider it as income, right? It as in revenue. Say the construction of that building will take place for 2-3 years. So after 3 years we are not going to consider it as income for us. Whatever the portion we have constructed, for that amount we can consider it as a revenue. Suppose the building value is 30 lakh. For constructing that building we are going to get 30 lakhs. Say we have, for it is a 3-floor building, so when construction of first floor is over, we need to consider it as the income of 10 lakh. When the construction of second floor is over, we are going to consider it as 20 lakh. When the construction of third floor is over, we are going to consider as 30 lakh. So in the first year, we have completed only one floor, so we need to consider 10 lakh as our revenue. Whether we have received that amount or not, but we still need to consider that much proportion of that construction work is over, so we need to consider 10 lakh as our income for the year. Similarly, when we are going to sold the goods on hire purchase, whatever the installment we are getting, we need to consider it as a revenue for the business. So this concept helps us to from preventing the management from inflating profit by recording incomes which are not earned. So this concept prevents the management from showing higher profits. Even though they are not received, they may show higher incomes. So this concept restricts the management to show such profits. So accrual concept. So accrual concept is the continued part of revenue recognition concept. In revenue recognition concept, we have focused only on the revenue. We are focused only on the income. But this accrual concepts give importance to both revenue and expenditures. So both revenue and expenses will be covered in the accrual concept. The same thing, whether we have received the amount or not, whether we have paid the amount or not, when we are legally liable to receive or pay the amount, at that moment we are going to consider as income and expenses. For example, for this month we need to pay the salary. Due to some reasons we are unable to pay the salary. We are going to pay the salary in the next month, but we should consider it as expenditure of the previous month, not the, suppose this month is April, so in the month of April we need to pay the salary. Due to some reasons we are unable to pay that salary in the month of April. We are going to pay that salary in the month of May. So whether that salary expenditure should be treated as expenditure of April or May, it should be considered as the expenditure of April, because in that month only it has been accrued. So the last concept is matching concept. Matching concept is nothing but we need to match. We are going to prepare the profit and loss account. In that we are going to show the incomes in the credit side and expenditures in the debit side. So this is based on the matching concept. We are going to compare the incomes with the expenses, and if the incomes are higher than the expenses, then we will get profit. If the expenses are more than the incomes, we will get the loss. The result will be profit or loss, and we need to match the incomes and expenses. That is called as a matching concept. Thank you.